The recent collapse of Silicon Valley Bank has some predicting a wholesale economic apocalypse and the collapse of the real estate market. I'm Eric with Andersen Homes, and in this video, we'll consider what impact the collapse of Silicon Valley Bank could have on the real estate market. The failure of Silicon Valley Bank is significant and represents the second largest bank failure in U.S. history. The bank was involved in some risky investments. They backed 50% of all venture capital funded technology. Now, having such a high proportion of their assets tied up in tech and life sciences resulted in about 94% of their deposits being uninsured, since most of them exceeded the $250,000 FDIC limit. Silicon Valley Bank also scaled very quickly over the past 3 years, with its assets nearly tripling. In 2019, deposits were about $65 billion, and by 2021, they had grown to a staggering $189 billion. The recent steep decline in U.S. tech companies' share prices caused a drop in SVB's share price from around $750 a share in October 2021, all the way down to $106 in March 2023. As SVB's vulnerabilities were exposed, tech investors stormed the bank to get their uninsured deposits out, and the bank couldn't recover. What does this mean for real estate? SVB is not a real estate-specific entity, and their collapse is unlikely to have a direct effect on home values in the short term, if at all. The bigger issues facing the housing market include higher interest rates, tighter lending standards, lack of inventory, and the possibility of a recession, all of which can have an impact on mortgage demand and home values. Now, some headlines are suggesting this will be 2008 all over again, but the challenges facing the economy this time around are different. The infamous ninja loans, where consumers could get a mortgage with no income, no job, and no assets, are not happening. The biggest issue facing the banks today is higher interest rates. This restricts loan availability and reduces demand, resulting in a lower valuation of bank assets. But this is a problem of short-term volatility, not long-term risk. And this is good news for the economy overall and the real estate market in particular. There's no denying the economy is under no little stress due to inflation, higher interest rates, and bank failures, and so some volatility in the equity and real estate markets is to be expected. But the current challenge to the banking system is driven more by short-term liquidity challenges than a systemic problem with the fundamental assets underlying the economy. To the question, is the housing market 100% safe? A recent Forbes article said, quote, "No, every investment, including real estate, involves some level of risk. And right now the housing sector is also under pressure from rising rates. Mortgages are now a lot more expensive than they were last year and the year before. That's significantly reduced demand in the real estate market, with sales numbers in January 2023 down 36.9% from a year prior. Prices have held up reasonably well so far, as there hasn't been a lot of inventory on the market, but they are starting to slowly decline. So the housing market is slowing, but it doesn't look like a collapse is imminent." Economist Susan Wachter, professor of real estate at the Wharton School of Business in Philadelphia, recently said, "Single-family and multifamily homes will be the first to recover if we go into a slowdown." The good news is the single-family mortgage market is actually in safe hands and it's stable. If you found this video helpful, be sure to subscribe to my channel for regular updates about the real estate market and homes for sale in Burr and the western suburbs of Chicago. I'm Eric with Andersen Homes, a family-owned brokerage where we treat our clients like family.